The housing crash of 2025 is no longer a distant prediction. It's happening right now, and the numbers are staggering. Across the country, cities that once symbolized growth and prosperity are suddenly drowning in listings, buried under price cuts, and overwhelmed by desperate sellers. Home values that soared only a few years ago are collapsing, in some cases falling by as much as 50 to 80%. For families, the fallout is brutal. Mortgage payments are crushing budgets, equity is evaporating, and what once felt like the safest investment, the family home, has turned into a financial trap. This isn't just a market correction, it's a reckoning, a reminder that when prices rise too far, too fast, they often come crashing back to earth. And in 2025, some cities are being hit harder than anywhere else. These aren't small, obscure towns. These are major metros, booming destinations, and once can't-lose markets now leading America's biggest housing collapse in decades. Today, we're counting down 10 US cities where the housing market is falling apart. Number 10, Denver. Colorado, Denver, the mile-high city, was long considered a dream destination. Nestled against the Rockies, it offered a unique mix of outdoor adventure, vibrant culture, and booming job growth. During the pandemic years, it became a magnet for remote workers and young professionals. Home prices soared more than 50% between 2020 and 2022, with buyers flooding in from around the country. By 2025, though, Denver's housing market is cracking under pressure. The median home price peaked near $600,000, making it one of the most expensive interior markets in the US. But affordability was already stretched to the breaking point. With mortgage rates hovering around 7%, monthly payments shot into the stratosphere, leaving many buyers with debt-to-income ratios that simply didn't work. Inventory tells the story. Homes for sale are up nearly 40% year over year, and properties are now sitting on the market for an average of 75 days, far longer than in the frenzy of just a few years ago. For families who bought at the peak, equity is disappearing fast. Analysts warn that if the economy worsens, Denver could see declines of 15 to 20% in home values, erasing years of gains almost overnight. And the risks go deeper. Denver's economy is heavily tied to tech and professional services. If layoffs continue to spread through the tech sector, demand could collapse further, forcing even more homes onto the market. The boom that once looked unstoppable could become a bust that rivals the dark days of 2008. For now, Denver remains beautiful, vibrant, and desirable. But beneath the postcard views of the Rockies lies a housing market showing unmistakable signs of strain. For buyers, this isn't the opportunity it once was. It's a cautionary tale. Number 9, Sacramento, California. Sacramento has always lived in the shadow of its coastal neighbors. For years, it was marketed as the affordable alternative to the Bay Area, a place where you could buy a house, commute if you had to, and still enjoy California living without California prices. During the pandemic, that reputation turned into a full-scale boom. Thousands of Bay Area residents fled sky-high prices and crowded neighborhoods, pouring into Sacramento and driving local housing values through the roof. Between 2020 and 2022, Sacramento's median home price skyrocketed by more than 40%, peaking around $540,000. For a while, it felt like everyone was moving here, and bidding wars became the norm. But fast forward to 2025, and the dream has turned sour. Prices have already dropped to about $450,000, a loss of nearly $90,000 in just a few years. For anyone who bought during the frenzy, that means they're sitting on massive losses. The parallels to 2008 are hard to ignore. Back then, Sacramento was one of the epicenters of the housing crash, with foreclosures ripping through neighborhoods. Today, the signs are disturbingly similar. Inventory is up more than 45% year over year. Homes are languishing on the market, and price cuts are everywhere. The Bay Area migration has slowed to a trickle, investors have pulled back, and locals, earning a median household income of just $75,000, simply can't afford the prices left behind. Sacramento's story is a classic example of how quickly external demand can inflate a fragile bubble. When outsiders stop buying, the entire market loses its foundation. Now, with mortgage rates making affordability even worse, Sacramento is bracing for another painful correction. For families who thought they were escaping the chaos of the Bay Area, this housing market may feel like deja vu in the worst possible way. Number 8, Tampa, Florida. Tampa was once the crown jewel of Florida real estate. Its mix of jobs, sunshine, and lifestyle made it a magnet for retirees, remote workers, and, perhaps most importantly, Wall Street-backed investors. Between 2021 and 2022, Tampa's housing market went into overdrive, with home prices jumping to an average of nearly $385,000. Frenzied bidding wars became the norm, and the city seemed unstoppable. But in 2025, the glow has faded. Prices have slipped to around $360,000, but the bigger story is inventory. Homes for sale are up more than 55% compared to last year, and properties that once sold in a week are now sitting for months. Sellers are slashing prices, but buyers are scarce. Thousands of Airbnb and short-term rental owners who once thought they'd struck gold are flooding the resale market as tourism softens and profits vanish. The warning signs couldn't be clearer. Tampa's boom was fueled not just by local demand, but by speculative investors chasing quick returns. Now, with mortgage rates stuck above 7.5% and financing harder to secure, those buyers are gone. What's left is a market oversupplied, overpriced, and overextended. For locals, the affordability crisis is severe. Wages in Tampa never kept pace with housing costs, leaving many residents priced out even before the downturn began. Now, as the market corrects, equity is evaporating, and those who bought at the top are facing losses they never imagined. Tampa's story is one of overexposure. Too many investors, too much speculation, and too much reliance on constant growth. As the bubble bursts, the once red-hot Florida housing market is cooling fast, and Tampa is right at the center of the storm. Number 7. Bakersfield, California. Bakersfield was never a flashy city. It didn't have the beaches of Los Angeles or the tech boom of Silicon Valley, but for years, its biggest selling point was affordability. People priced out of California's bigger cities flocked to Bakersfield because it offered something rare in the Golden State, a chance to actually own a home without drowning in debt. That affordability, however, is now gone. Between 2019 and 2022, home prices in Bakersfield nearly doubled, climbing from around $240,000 to close to $440,000. The city's modest wages, largely tied to agriculture, oil, and logistics, simply couldn't keep up. Families who once looked at Bakersfield as a refuge from high housing costs are now struggling to pay mortgages that eat up most of their income. In 2025, the cracks are showing. Median mortgage payments have soared beyond $3,000 a month at current rates, a figure far out of reach for most local households. Investors who piled into the market during the boom, buying nearly 1 in 4 homes at one point, are now dumping properties, often at steep discounts. Homes that were once snapped up within days are now lingering for months, with sellers slashing prices by $50,000 to $100,000 just to attract attention. The danger for Bakersfield is stark. If local wages continue to stagnate and interest rates remain high, housing prices here could collapse by as much as 60%, falling back to pre-2005 levels. That would devastate homeowners who bought at the peak, wiping out years of savings and equity. For now, Bakersfield still offers more space for the money than most parts of California, but the city's fragile affordability, once its greatest strength, has now become its Achilles heel. What was supposed to be California's affordable alternative may soon become ground zero for its next housing disaster. Number 6. Dallas, Texas. Dallas has been one of America's fastest growing metros for decades. Corporate relocations, a booming tech sector, and endless suburban sprawl turned North Texas into one of the hottest housing markets in the country. Between 2020 and 2022, prices surged by as much as 60 to 80% in some neighborhoods, while new construction exploded across the region. For a time, it looked unstoppable, but Dallas may have flown too close to the sun. In 2025, inventory is rising rapidly, up nearly 45% compared to last year. Homes that used to sell in a matter of days are now sitting on the market for 75 days or longer. Price cuts are becoming routine, and sellers are competing to attract a shrinking pool of buyers. The problem isn't just higher interest rates. It's that Dallas's growth was heavily fueled by corporate relocations and investor activity. When companies were expanding, thousands of well-paid workers moved in, keeping demand strong. But with the economy slowing and layoffs spreading across tech and financial services, that stream of buyers is drying up. Investors who bought aggressively during the boom are now rushing for the exits. Dallas. Further adding to the glut of homes on the market, Dallas is massive, and its housing market reflects that scale. When prices surge across such a large metro, the fallout is equally widespread. Families who bought in 2021 or 2022 are already watching their equity vanish. Builders who overproduced during the boom are now offering heavy discounts just to move inventory, and with affordability stretched to the limit, even modest declines in demand can trigger sharp price drops. Dallas still has the jobs, the infrastructure, and the appeal of Texas's no income tax advantage. But right now, those strengths aren't enough to shield it from a painful correction. For many homeowners, Dallas no longer looks like a land of opportunity. It looks like a bubble finally running out of air. Number 5, Sedona, Arizona. Sedona isn't like the other cities on this list. Known for its stunning red rock formations, spiritual retreats, and booming arts community, it was never a working class city. It was a luxury market, an enclave for retirees, second home buyers, and affluent investors who wanted a slice of desert paradise. During the pandemic, Sedona's housing market exploded. Wealthy buyers flocked to the area, driving median home prices to nearly $850,000. Demand seemed insatiable, and homes often sold to cash buyers well above asking price. Short-term rentals flourished, with investors betting on Sedona's appeal as a vacation destination. But in 2025, the cracks are clear. Inventory is up more than 35% compared to last year, and homes are sitting on the market for more than 100 days. Price cuts are becoming the norm, particularly for multi-million-dollar properties that once seemed untouchable. The affluent buyers who once drove Sedona's boom are now pulling back, put off by higher mortgage rates, falling rental returns, and rising insurance costs. And those insurance costs are a big deal. With wildfire risk increasing across Arizona, premiums have spiked, adding thousands of dollars to annual home ownership expenses. Add in Sedona's already high cost of living, steep HOA fees and exclusive communities, and shrinking demand for second homes, and you've got the recipe for a painful correction. For Sedona, the danger isn't just declining prices, it's stagnation. When luxury homes sit empty, neighborhoods lose vitality, investors walk away, local businesses suffer, and the charm that made the town so desirable in the first place begins to fade. Sedona may not face the same scale of foreclosure crisis as working-class cities, but its correction is no less serious. For buyers, what was once marketed as a safe haven of natural beauty is now a risky bet in a fragile luxury market. Number 4, Las Vegas, Nevada. Las Vegas is no stranger to housing bubbles. In 2008, it became one of the epicenters of the nationwide crash, with entire neighborhoods of half-finished homes left abandoned in the desert. Fast forward to the pandemic years, and history seemed to repeat itself. Fueled by migration, investor activity, and cheap money, Las Vegas home prices skyrocketed. From 2020 to 2022, values surged more than 60%, with median prices peaking close to $450,000. But 2025 is telling a different story. Inventory is up more than 50% compared to last year, and the frenzy has cooled into a freeze. Homes that used to sell in hours are now sitting on the market for months. Price cuts of $30,000 to $70,000 are becoming routine, especially in suburban communities built for investors chasing Airbnb riches. The problem? Oversupply. Investors poured into Las Vegas betting on endless tourism and rental demand. But as the economy slows, visitor spending is down, rental rates are softening, and many investors are desperate to offload properties. Locals, meanwhile, can't keep up with the prices left behind. Wages in Vegas, largely tied to hospitality and services, never match the housing boom. And then there's the issue of water. The Colorado River crisis has put the region's long-term sustainability into question. Rising insurance premiums for heat, drought, and even flooding risks add another burden on homeowners. For many, the math no longer works. Las Vegas has always been a gamble. In 2025, its housing market looks like a losing hand, one that could see prices fall another 20 to 30% before stabilizing. Number 3, Boise, Idaho. Boise was one of the biggest pandemic housing stories in America. Once a quiet, affordable city, it suddenly became the poster child for migration-driven price booms. Californians, Oregonians, and Washingtonians flooded in, driving median home prices from around $300,000 in 2019 to nearly $500,000 by 2023 2022. For a city with modest local incomes, the surge was breathtaking and unsustainable. By 2025, the bubble has burst. Prices are down nearly 20% from their peak, with the average home now selling around $400,000. Inventory is piling up, with homes sitting unsold for months as buyers balk at the mismatch between wages and housing costs. Local incomes hover around $70,000 a year, but at current mortgage rates, monthly payments on a typical Boise home eat up more than 40% of take-home pay. Boise's rise was fueled by outsiders bringing in wealth from more expensive markets, but that migration has slowed dramatically. With remote work opportunities shrinking and affordability collapsing nationwide, Boise is no longer the cheap alternative it once was. Investors who once snapped up homes for rentals are also pulling back, leaving locals with inflated prices and fewer options. The cultural impact has been just as sharp. Longtime residents resent the influx of outsiders who drove up costs, and many are cheering the correction as a return to reality. But for those who bought at the top, the correction is devastating. Tens of thousands of dollars in lost equity, with no guarantee that prices will recover anytime soon. Boise's crash is a warning to other cities. When growth is driven by outsiders and speculation, the foundation is fragile, and when that foundation cracks, the fall is swift. Number 2, Cape Coral, Florida. Few markets have seen a roller coaster ride quite like Cape Coral. Known for its canals, boating culture, and proximity to Fort Myers, Cape Coral became one of the hottest destinations during the pandemic. Buyers from the Midwest and Northeast, chasing sunshine and affordability, poured into the city. Home prices doubled between 2019 and 2022, peaking around $450,000. But today, Cape Coral is one of Florida's most troubled markets. Inventory has surged by nearly 70% year over year, making it one of the most oversupplied housing markets in the nation. Properties that once sparked bidding wars now sit unsold for months. Sellers are slashing prices by tens of thousands, and still the buyers aren't coming. One of the biggest issues is climate risk. Cape Coral has been hammered by hurricanes in recent years, driving insurance costs to record highs. Some homeowners are paying over $10,000 annually for coverage if they can even get it. Add in flood zone requirements, HOA fees, and property taxes, and the total cost of ownership has become staggering. For many buyers, it's simply not worth it. The reliance on out-of-state buyers also makes Cape Coral vulnerable. As the national market cools, retirees and investors are pulling back, leaving a glut of overpriced homes in their wake. Locals, earning far less than the influx of buyers who once drove the boom, are priced out entirely. Cape Coral's boom felt like paradise on the surface, but in 2025, the dream is sinking under the weight of insurance costs, oversupply, and economic headwinds. Number 1, Phoenix, Arizona. Phoenix has been one of the hottest real estate markets in the country for more than a decade. Its population surged, fueled by affordable homes, endless sunshine, and job growth in sectors ranging from healthcare to technology. Between 2010 and 2022, home prices more than doubled, with the pandemic years adding fuel to the fire. At its peak, the median price hit $475,000. But in 2025, Phoenix is cracking under the pressure of its own success. Prices are down nearly 15% from their highs, with inventory climbing by more than 60% compared to last year. Homes that once sold in bidding wars are now collecting dust on the MLS sellers slash prices weekly, but buyers are holding back, waiting for deeper discounts. Phoenix's challenges are layered. Affordability has collapsed. Median household income sits around $75,000, but monthly payments on a median-priced home at current rates exceed $3,200. Water scarcity is another looming threat, with the Colorado River crisis raising serious questions about long-term sustainability. Add in extreme heat, rising insurance premiums, and overbuilding in suburban sprawl, and the cracks are everywhere. Investors, who once made up nearly a third of buyers, are retreating. Short-term rental markets are oversaturated, pushing more homes back into the for-sale inventory. And with interest rates keeping affordability out of reach, many buyers have simply walked away. For Phoenix, the question isn't whether the market will correct, it's how deep the correction will go. Analysts warn that prices could fall another 20% before stabilizing, wiping out much of the equity built over the last 5 years. Phoenix is a powerful symbol, the fastest growing metro in America now leading one of the steepest downturns. The sun may still shine on the Valley of the Sun, but for its housing market, the outlook is stormy, and there you have it, 10 US cities where the housing crash of 2025 is hitting hardest. From Denver's mountain views to Phoenix's desert sprawl, these markets once felt unstoppable. For some, this crash will mean opportunity, lower prices, less competition, and a chance to finally enter the market. For others, it will be a painful reminder that housing isn't always the safe bet it's made out to be. Thanks for watching, and stay tuned as we continue tracking the biggest stories in America's housing market.